Hey everyone, Barry Brooksby here. Welcome to my Wealth Optimized YouTube channel. There is talk out there about different types of PUA to base ratios. We call these splits. And a lot of agents love to promote a 60-40 split. Some agents are promoting a 90-10 split. Well, what's the right split for you? It really depends on your goals. But I can tell you, a lot of the agents out there promoting the 60-40 split, they're earning higher commissions. Whereas in a 90-10 design, those commissions are lower and you wind up with more cash value in a policy. But you want to look at your goals. As you have a policy designed for you, it could be a 60-40, could be an 80-20, it could be a 90-10. A 90-10 generally is going to give you higher earlier cash value, whereas a 60-40 might give you higher later to retirement year cash value. So depending on what type of goals you have, the different ratios between PUA and base will be affecting the way the policy is designed to meet those goals that you have. We're going to dive into some of these numbers and you're going to see for yourself. The bottom line when you're thinking these types of splits is maximum cash value. Maximum cash value is going to give you the best policy now or the best policy in retirement. So let's take a look at the numbers and dive into exactly what the 60-40, 70-30, 80-20, and 90-10 designs look like. Here we go, PUA and base ratios. We're going to be looking at two companies. We're going to start with company A here. And the way that I've designed these illustrations, it's based on a $10,000 annual premium payment, 35-year-old male, and then this policy also has a 20-year term insurance rider. And then we do an RPU starting in year 21, meaning no more premium going into the policy. This is a whole life policy. The reason for the term insurance rider is because it raises the MEC limit and allows you to get more cash in the policy. So what we're looking at first is the 60-40. 10,000 goes in and we see the net cash value of $6,771. In the 20th year, we see the cash value of $277,000. Now, how does that compare to the 70-30? In the 70-30, the first year cash value is $7,480. The 20th year, the cash value is $282,000. In the 80-20 design, we see $8,148 in first year cash value and $286,000 in 20-year cash value. And the 90-10, the first year cash value is $8,884. The 20-year cash value is $295. As you look at the 60-40, compared to the 90-10, the 90-10 has higher first year cash value and it also has higher 20th year cash value. As a matter of fact, it also has higher 5th year cash value and higher 10th year cash value. In every year, the 90-10 design always has higher cash value than the 60-40 design. If you have a life insurance agent trying to convince you to do a 60-40 split, you can clearly see here that the 60-40 PUA to base ratio does not have higher cash value in any of those years. And as we look at the death benefit comparison, even the death benefits in the 90-10 design are higher. $220,000 in year one compared to $180,000 or $184,000 or $213,000 in the 60-40, 70-30, and 80-20. And then in the 20th year, we have $691,000 of death benefit in the 90-10 as compared to $585,000, $611,000, and $659,000. So in all instances here with company A, the 90-10 is better for cash value growth and it's better for death benefit. The reason is because the majority of your premium is going into PUA. It's growing more cash value. And it is a lower commission. Frankly, most agents don't like this. They want to earn higher commissions, which is why they're going to steer clients towards a 60-40. And I've even seen some policies designed with a 50-50 or worse. So when you want the highest cash value growth with company A, the 90-10 design is the best way to go. And the agents earn a lower commission. Most agents don't want to sell the 90-10 because of that. Now we're looking at company A compared to company B. You might think, well, why are we looking at a second company? I like to do this with all of my clients, show several companies, and based on a client's goals, you're going to like one over the other. But take a look at this. With company B, their 60/40 design has lower cash value in year one, $5,371 compared to $6,671. But look what happens as time goes on. By the time we get to year 10, company B's 60/40 design has $106,477 compared to company A's $105,000. And in 20 years, company B, their 60/40 design, $296,000 of cash value as compared to company A, $277,000. Company B's 70/30 design is very similar to their 60/40 design. We're not going to get into that because they are so similar, but I do want to take a look at the 80/20 design with company B. In year one, $7,093 as compared to company A, their 80/20 design of $8,148. But the same thing happens. By the time we get to year 10 with company B, their 80/20 design is $111,000 in cash value as compared to company A with $110,000 of cash value. And by the time we hit year 20, company B is $304,000 compared to company A's $286,000. Company B does not have a 90/10 design, but look at this. Long term, company B's 80/20 design is actually higher in cash value than company A's 90/10. We don't see that in the early years, but eventually it does happen. So company B in year one, $7,093 compared to company A's 90/10 design of $8,884. But in year 20, company B's 80/20 design has higher cash value than company A's 90/10 design. It's $304,000 compared to $295,000. The way you would think about this is if you want the highest cash value in the early years of your life, 90/10 is more than likely going to be the design for you. But if you want the highest cash value in your later years, your retirement years, you'll more than likely want to go with an 80/20 from company B, because we can clearly see here that as time goes on, company B's cash value is larger. And by the time you hit the 25th year, the 30th year, and so forth, the cash values incrementally get larger in company B's 80/20 design. Don't be fooled into thinking that if an agent tells you a 60/40 is more efficient, that that's the policy for you. Because in most cases, the 60/40 is not more efficient. And when I say more efficient, I'm talking about the bottom line cash values and the bottom line death benefits. There might be some math that an agent could put together to show some efficiency improvement, but if it doesn't translate to more cash value for you or more death benefit, it's not a policy that you would want to purchase. When I design these illustrations for my clients, I want my clients to get the best of the best. I want them to see multiple companies. And there obviously are different premium amounts that clients are going to put in. This is based on $10,000 a year. You could put in $50,000 a year. You could put in $100,000 a year or more. And some people like to add lump sums. They might say, I want to put in $25,000 a year as my contract premium, but I want to add an additional $50,000 or $100,000 first year lump sum on top of that to turbocharge the cash value. But in all cases, you want an illustration designed to meet your goals. The top benefits of a properly structured high cash value whole life policy are these. Guaranteed growth of your money. You will make money every single year for the rest of your life. Access to liquid cash. You're not locking up your money. Your cash is liquid. You can take policy loans to invest in real estate, to invest in your business, to pay off higher interest rate debts. And having access to liquid cash allows you to be your own bank. You can use this policy as your own bank to invest in other assets. Protection. Yes, you get a permanent death benefit that will always be there no matter when you pass away. But the cash value is also protected in most states from creditors, lawsuits, and even bankruptcy. It's a very safe place to store cash. And if done correctly, you can use your money 100% tax-free, now and in retirement. There are many more benefits than these four. These are the top benefits of a properly structured high cash value whole life policy. I would invite you to look at your own numbers. You can click the calendar link below to schedule a call. Continue to watch the educational content on my YouTube channel at Wealth Optimized. And as you're thinking of your own PUA to base ratios, be sure that the policy is designed exactly the way you want it to meet your goals.